What's up, Colorado? Chris Lopez here, and today we're going to be talking about commercial real estate lending. Now, here's a couple words you normally don't hear in the world of commercial real estate. We're talking lending, but I've got two gentlemen in the studio today who are forward thinkers in the space, and I would say innovative, which has always been one of my frustrations with the commercial world. As you know, over the last 6-7 years, I've really gotten into real estate investing. I started out in commercial, and I was very frustrated by how slow that market was. I saw so much opportunity out there, like, wow, there's so much opportunity to be innovative, to be marketing focused, do this, do this, do this. And I was like, wow, the commercial world is resistant to it. So I've always had a little bit of like, tug and pull there with commercial, but I always look forward to networking with people. And just through the standard power of networking, talking to people, being persistent, I've been very fortunate to, over the last couple months, meet two commercial lenders who are great lenders, but also that forward-thinking innovative. So I'm very glad to have you guys in the studio. Adam Aluise, you were here a few podcast episodes ago, I believe, talking lending.
Yeah. Thanks for having me back.
Yeah, we got some big news here to talk about what's happening in your business like a week after it.
Right.
Last but not least is Mr. Michael Kaplan, who is the president of Slatt Capital. And you are just a wealth of knowledge, been in the industry for years. And Slatt is coming to the Colorado market with some forward-thinking ideas, and I'm excited to dive into it.
No, I appreciate being here and having the opportunity. It's a new frontier for us, for sure.
Yeah.
So looking forward to it.
But like I said, it's always like you guys are like great at your profession, but just your mindset and outlook is always like you're forward-thinking, which I find so refreshing because that's how I am. So Adam, let's start with you because last time we were here, we were talking the market, what's going on. And I think a week after we recorded that podcast, you went through some major business changes, right?
It's amazing what happens when you get on your podcast. Life changes for the better.
Oh my gosh. I wish I could take credit for that one.
No, I mean, it was great. So I don't think we shared too much about it at all. So
no, we shared nothing.
To give, I guess, a little just, overall background.
A little background you first.
To where we've come from. So, prior to, being a part of Slatt and then having my own firm. So I was a 15-year commercial real estate corporate lender, right? Worked my way up through an analyst to a portfolio manager, originator, started doing some investing myself on the side, did a little development work, some value add properties. Really enjoyed all of that, kind of stepped away. There was some various things in corporate America that I was not too excited about. And so I was like, hey, I'm going to take a run on doing some stuff myself. It was going to be more development investment. That was in January of 2020.
Oh, great
March
time.
of 2020, nailed it. nailed the timing. And so then March came and I was scared. At this point, like nobody's knowing what's really going on with the COVID thing. And so I was like, what do you know? I was like, commercial real estate, lending, have various relationships here in town. Called a couple friends, going to do some refinances, help with some purchases. Debt at that time was very attractive compared to where we are now. One deal turned to 3, turned to 10, turned to 15. And I was like, oh my gosh, I think there's a market for this. Have the background in underwriting, have the background in administration. What I'm best at is kind of the outreach, and structuring some of the deals and knowing where to place it. The issues that I was running into was on the hiring side. And it, I mean, if I want to be honest, it was kind of my own fault, is just the back office stuff.
Yeah.
Right. I mean, putting the underwriting, the packages together, and then getting like the closing. And so, I had a mentor that I'd known here for many years that had done something similar, and he was going through, I guess I want to say maybe like, he was selling a portion of his business to Slatt. We had talked about that, and he was the one that actually teed up my relationship or getting to know Michael and Dan and their firm. It's just amazing how it works. They were interested in opening up a Denver office. They had purchased a separate company. I guess they were based in California at the time. Kind of the Colorado location was the second, and then it was like, hey, we're all in. They obviously have a lot of investors. So let me back up, and I can tell Michael can do it better than that. But who Slatt is, that's a little background on me. And so I'm opening and managing the Denver office, right, for Slatt Capital.
Which I'm excited about because I get what you're saying. Like, hey, you're very good at doing this part of the process, and very few people can do the whole process of brokerage, of lending, of anything. That's just not the way humans are wired because there's so many different steps on there, and they take different personalities and skill sets. And so, but it's always that point where you always want that local expert. But with lending, you have the local expertise and knowledge, but you really need a national infrastructure, especially on the commercial side, the national lenders, regional lenders that you guys have access to. There's a very, hey, you need the local, but you need that national infrastructure. And from my perspective, I think that's where Slatt and you is just an amazing partnership. And nobody know about Slatt, talking with you and your team last couple of weeks, Michael. I've been so impressed hearing about the growth of Slatt Capital and the space you carved out for yourself, and also just the ideas you have for growing Colorado market share. So with that, give us a little background about you and Slatt, please.
Sure. No, happy to do so. So, Slatt Capital is a 52-year-old company. I've been with the company for 25 years. So, a lot of time with family. And that's really what we've been building. The genesis of the company, it was started by Barry Slatt, who was an individual, kind of a failed developer in California during the 70s, realized, wasn't his cup of tea, figured, hey, I know the lending business, I know the real estate business. How do I develop a firm that doesn't have a ton of overhead and can make money and serve, commercial real estate needs? And so, in the 70s, it was a pretty fragmented market. But he saw an opportunity and developed the firm with relationship focus first, which, standing in the halls of, one of the first mortgage conventions in San Francisco, filled with insurance companies looking for local representation. That's where the genesis of the company started. So in 1973, Barry was able to secure a correspondent relationship with American United Life. That was our first entree into the insurance correspondent business, which is the backbone of our firm. And so fast forward to today, we represent 20 different insurance companies, all different sorts of makeup amongst those 20 insurance companies with respect to where they're located, what their investment strategies are. And our firm is basically their eyes and ears in particular markets where they want to do origination. They're based in Des Moines, or they're based in Omaha, or they're based in other parts of the country. They don't have the capacity to build production offices across the country. Mm-hmm. So they identify firms like Slatt to be their origination arm and be their servicing arm. So, we try and stay in our lane with respect to those relationships. It's, a broad-based platform, 1 million to, 30 million. But, the majority of our relationships are true middle market focused. And so over the years, we've built a company that really focuses on that relationship and what they want in a particular market. And sometimes that brings us to other markets. Sometimes that keeps us very local. So we're a, $5.2 billion servicing mortgage banking firm. We're headquartered in California. But we service 1,600 loans across the U.S.
Are most of those loans that you originate, or do you also take ones from other lenders as well and do general servicing?
We're open to subservicing or collaborating with other mortgage firms that may not have the back office to run a servicing program. The 99% of what we service, we have originated.
Okay.
And if you look at the map, so to speak, we're still heavily concentrated in California. Probably 68% of our servicing is in California. Other highest concentration states are, logically, coming from California investors. So high number of loans in Texas, obviously Pacific Northwest, Nevada, Colorado, kind of the smile states, into Florida, the Southeast and stuff. Not a whole lot in the Northeast, but it's growing. As insurance companies continue to evolve and have demand to be in certain areas, they look to certain mortgage banking firms like ours and many of our competitors and say, hey, we're really underserved in this market. What do you think about that market? Do you have any people on the ground there that can help us grow that market? And so, we do have some national accounts, but more, specific. The insurance companies really look for expertise in the market they want you in. So, being in California, we have 7 offices in California, and we're gradually growing.
Yeah. And so what's the kind of story about the Colorado expansion? Like you told me, but I want to have you guys repeat in the podcast. I found it fascinating.
So we again, I mentioned, California investors, and, not that, people aren't welcome to do business in Colorado from California. For us,
we do a lot of 1031s with Californians coming out.
Exactly.
we know the trends.
Yeah. So we followed a lot of our clients over the years here, and buying really well located, performing real estate. And a lot of that was being financed with our correspondents that we represented in California, with them allowing us to follow our client into the marketplace. And, not every deal was done with an insurance company. We certainly placed banks and credit union and, CMBS loans with those investors. And a lot of times those lenders on the bank and credit union side were local. So, over a time period, we've developed, local relationships with certain investment brokers, leasing brokers, bankers, and other mortgage bankers that were actively in this market. And so, relationships going back 20 years where we would see these individuals at, our annual conferences and walk down the hall and, we'd be at the same lender cocktail party and we sit and say, hey, what's good? What works? What's not working? And even though we were competitors, we were friendly competitors. How's business going? How are you training your young producers? How are you building back office support? Are you building back office support? How do you make it work only servicing $350 million? How do you justify the expenses?
Yeah.
Little things like that. We all shared ideas. And, over time, you build these friendships. And to us, with a firm that is so rooted in family, my partner, Dan Friederberg, I've known since I was 16 years old. So we've built this firm together over the years, and the majority of our senior leadership or our senior mortgage bankers have been with the firm 10, 15 years, if not more. So we've taken that approach to our competitors. They are friendly competitors. And so, when seeing that we were doing more and more origination in the Colorado market, it was reach out to those guys and say, hey, look, we're not trying to step on toes. We're following clients. By the way, you represent a few lenders that we don't represent. Maybe there's an opportunity to do some co-brokered business. And so start there. Say, hey, let me bring a client to you. Let's work collaboratively. So some of the relationships were strengthened by doing deals together. Then it gradually grew into, hey, we're doing more business there. Our lenders are asking us to do more business in that market. How do we really do it the right way?
Yeah.
It's not easy to do it from California. You can say, hey, I know that area. Do you really know that area?
Not like Adam does, though.
Right. Do you really know what's going on in that corner or in that corridor? Do you know why those tenants are there? Where are the demand drivers? Do I know the city planners? Do I know the top brokers here? I don't. Now I can go on CoStar and look and figure that out, but I'd rather have someone on the ground. And that's where the idea of, hey, if we're going to continue to do the volume that we're seeing and that our lenders want in that market, we got to have the right guys on the ground.
Cue up Adam, huh?
Yeah.
And I know you got some other people on board as well, but I think Adam, you're taking a big lead in all here. So I'd love to kind of to shift the conversation, because it's great to hear the overall story of, hey, relationship focus, great track record, and you got the big infrastructure, but you got the local knowledge, and you're also able to stay very nimble as well to go out there and get deals done.
Yep.
So kind of from your perspective, Adam, you've got a new arsenal behind you, new back office. What's the landscape? What opportunities do you see out here in Colorado or in Denver, just in general for like commercial? And it's a very open-ended question, whether
It's
for
a very open-ended question.
people to make, moves, or now that you got some of these new lending relationships, like, how are you going to make some magic happen out here? Like, what opportunities are there?
Oh my gosh, that is a super open-ended question. And let me try to digest that. From the investment perspective, from the lending perspective, like, so how...
Wherever you want to take it. I'm curious. Like, I have a million questions I want to ask you guys, so that's part of my such an open-ended question, so I apologize for that.
Right.
But, like, let's just start with the investor, because that's what always matters here. End of the day, we're all here to serve the investor.
That's right.
Let's make sure that investor gets the right deal, the right terms, the right things. So let's start with the investor, because end of the day, that is who matters.
Right, right. And so, I mean, I think it probably helps just give like the background of like where is the value add, right? And so, and we talked about it a little bit before is, what's most important, I guess it's going to be different for everybody, but from obviously there's going to be the pricing perspective, right? Like where can you get the best, pricing? How do you get the best terms? What are the best terms, right? Is it something that's going to be more of a short-term project? Is it more of like a long-term stabilized product or project? And then what specific sources of capital, are you looking for, right? Is it going to be kind of more of like on the debt side, or not on the debt side, but on the bank side, credit union side? Is a life insurance company deal? What we're seeing, I guess, right now, especially in the market, or at least like what I'm saying is, we're talking to 20 to 30 lenders a week. It's just kind of part of my weekly, hey, what's going on is, and I don't want to speak for everyone, but a lot of the banks are getting a lot more stringent for their underwriting. A lot of the pricing is going up, which is leading to more deals kind of opening up on the life insurance side. Some of the pricing for stabilized deals, right? I mean, what I'm seeing is not a lot of value add deals getting done right now. I mean,
is that because like the debt terms can't get through?
A lot
of
lenders aren't lending on pro forma. Right. So, I mean, a lot of the stuff that we were doing last year was even on the multifamily side that we talked to. It's like, okay, kind of what does that deal look like? Right. It's the typical, it's
so even with an experienced operator and they're saying, I've done, dozens of deals
it doesn't cash flow. You know what I mean? Day one. So usually you want to get to a one. I shouldn't say all the time, but usually like for me, it was like a 1-to-1 on the current market. And then we need to get it to a 1-to-5 on the stabilized.
Okay. So you've seen stuff open up on the stabilized side, a lot through life insurance, but the value add side,
value add stuff is drying up a little bit.
Okay.
And same probably with construction right now, with obviously materials costs, and then, some lenders tie to the Wall Street Journal prime index, which will probably see 50 basis point increase on the next couple of weeks. So, I mean, what's that, 8.25? And that's without a bank putting a margin on it. So, I mean, it gets very expensive very quickly. And so, I think a lot of people are trying to figure out, what does the market look like? Where are the opportunities? And so, we're trying to share what we know to try to get the deals done on the debt side, and then putting some good people together to try to strategize, and maybe putting some deals together or deals together with each other. But I will speak for me trying to navigate that myself, like where are we going to find? Well,
here's something I'm really just to get your perspective on, especially, since Slatt has $5 billion plus in servicing. So you guys, get to see a unique perspective, because you can see on the servicing side, on the residential side, we always talk about, hey, it's going to be a wave of foreclosures. That's not happening. Now, with the huge run up in interest rates, are we going to see a lot of assets starting to be, banks starting to force these investors sell assets because they can't meet the interest rate jump in a year when their debt comes due or starts floating? Like, are you seeing any interesting trends or patterns, good or bad, on the servicing side or just in general?
I mean, fortunately, within our servicing world, in the insurance company servicing world, most of the loans are conservative. They are definitely lenders that are borrower centric. So, generally speaking, our properties or where our problems tend to come from are not necessarily property related. They're borrower related. If there are any issues, having a long track record of servicing, going back through arguably the worst financial crisis in, 08, 9, and 10.
Yep.
And even through COVID, our firm has not had a default in our servicing department.
Wow.
So now, have we had late payments? Have we had forbearance provided by lenders because borrowers were in good standing? Absolutely. But we currently have no forbearance in our portfolio, and we currently have no defaults. Now, you asked about the greater market. Yes, there are issues. You are seeing it. The media is very loud at the moment about office properties.
Oh, yeah.
And big office owners giving property back. That's institutional. Very much focused in that large balance loan world, higher octane lending, so to speak, in many of those examples. When you scale it down to the middle market, 2 million to 30 million space, we have not seen the strain, and therefore there is strain, but we have not seen it come to the point where lenders are moving to either foreclose or to, bring it to that hard decision.
Right. Yeah. So I think I understand your question a little bit more now, right? From an investor perspective, where are they going to see some opportunities in the near future?
Yeah.
Right. And so I think it looks something like 2-3 years ago, somebody gets a loan and it's at 3.25 and they leverage it up 75%, and they're the smartest guy in the room. There's not a lot of capital to bring to the table. Everybody's giving like high fives. This is the best. It's a different situation when, that debt matures,
so let's say it's a 5-year arm.
It's like, 5-year arm, 3-year arm, right? And then so it's like from 3.25, your leverage up, you're maybe at a 1.25 debt service coverage ratio. And now your debt is, I'm making this up, like 7%, right? And now you're way underneath. And, now the problem is you probably can't get refinanced unless you have a capital pay down, right? So it's a lender calling saying, hey, Adam, your metrics are a little below where we need them to be. You need to make a $500,000 curtailment or you got to sell this. Right. And so there's probably I don't know how many, folks are going to not be able to pen those checks, but there'll be some assets coming on, line a little bit.
There's still a lot of kick the can down the road a little bit mentality right now. One of the things we are seeing, which is, it's a little unnerving, but you're seeing a lot of strain in that bank and credit union space. And really what that is you've got a lot of regulators going into those offices and looking at their books and saying, hey, look, you guys did a great job the last handful of years. You put out product, you helped your communities. But, the reality is you did a lot of long-term fixed rate lending, and it's on book, and you haven't been able to move that paper because there aren't active buyers for that paper because it's at such a low return. And so, a lot of the credit unions, a lot of banks are sitting with pay good loans, but the auditors are going, look, guys, you got to mark to market these, 4% 10-year fixed rate loans, almost 200 basis points. Now run your economics. Now run your coverage. You're below your minimum threshold. We need you to reserve. So why is, what is happening as a result of that? Banks and credit unions are now saying, hey, we need some deposits. We'll do your new loan market rate, but we want a compensating depository balance because they're trying to get their ratios in balance.
Right.
Now, that's not across every credit union or every bank. There are a lot of credit unions and a lot of banks in this market and other markets that did not go crazy and did not, stayed in their lane, so to speak, and did the type of lending that they should have been, which is more shorter term in nature and match fund. Those guys are still very active. in the market, and they're market rate lenders, but they're able to do new loans and be active in the marketplace.
Right. Well, and I think that's a good point even to bring up, and why sometimes life insurance companies are nice too. I mean, because it's very typical for any bank or credit union to have annual reporting or annual covenants they're taking a look at. And so that sometimes that can get you in a little bit of a trouble. Whereas, some life insurance companies, once it's on the books, I mean, they're not going to have those annual, covenants or ratios or thresholds.
They don't have the reserve requirements, right?
The rate is completely different.
Yeah.
I guess they're not regulated.
Yeah. I mean, they may have a post-closing covenant that is more reporting oriented. Send us your income and expense, year-end statement, and send us a rent roll, and send us your financial statement.
Right. Great.
It's a file filler. It's, hey, our loan's in good shape. If it's not, we'll put it on a watch list. But they are not necessarily re-underwriting the deal every year. And if you fall below a certain metric on debt coverage, they have the right to call that loan or require you to pay that down.
Okay.
The majority of insurance companies don't have those post-closing covenants. That's not to say they, on a certain deal, they may not require it. They may. That may be in order to get X, Y, or Z term that you need. We'll have that post-closing covenant in there, but the vast majority do not have that.
Yeah, that makes sense.
Banks or credit unions, they all have post-closing covenants: liquidity covenant, DCR covenant, occupancy covenant, CMBS loans. If your property goes dark, we're going to sweep your cash flow. If you lose a major tenant, we're going to, trigger the lockbox and funded reserves. So we're in that environment right now where a lot of that's happening.
Right.
You lose a big tenant, your occupancy is down.
From a high level, and of course, with that in mind, and we're recording this in March, and I think rates will go higher and stay higher longer than really anticipated a few months ago. So, are we going to see more pain in the market and more people being forced to bring some reserves or sell their assets next year or two? Do you think? Like, is more pain coming?
That's what it appears right now.
Yeah, I mean, I think pain is relative.
Good point.
What does that pain look like?
Yeah.
Look, there are a lot of really good loans out there right now that we service that have really good sponsorship behind it, that are flush with capital, and can manage the storm, so to speak. Where I do expect to see some further cracking is, look, syndication business, where you don't have a lot of ownership of whoever's managing that, and they're having to pick up the phone and have very difficult discussions, to their investor base, saying, hey, we've got an event coming, our pro forma, we have not met our pro forma. We are 300 basis points different in exit interest rate than we pro forma'd. We would like to keep this property. In order to do so, we're going to have to refinance, and we need a capital call of, whatever it is, X percent. Some of those calls will go fine, but a lot of those calls, there's going to be some pain.
And that's what I'm thinking of, like those situations. Because I know, last 5 years, 7 years, syndications have been like one of the sexy things in real estate. And I know a handful of people now, more, younger, newer syndicators. Yep. And some banks are forcing them to sell some assets right now.
The established groups, and there are a lot of them out there, the guys that know what they're doing, they've properly reserved, they've properly adjusted portfolios correctly because they have the expertise. They have been through cycles. It's the new players that,
young guns.
Yeah, I mean that have only seen a low interest rate environment, only seen rent growth, and so there are a lot of those groups that said, hey, we're going to continue to have 3% rent growth, and we're going to continue to have cap rate compression. That was their pro forma. Their pro forma wasn't
3% rent growth, more like 8% rent growth.
But pro forma. But a big part of their pro forma was cap rate compression. and cap rate compression is not happening.
Well, it's even hard. I mean, on our side too, not even to make it like larger syndicated deals. Is like we're doing some refinances from some local banks that because of regulation issues, they can't do the permanent, right? So they gave like a 12, 24 months bridge IO period for these people to stabilize. Now they've stabilized the deal and they don't have a takeout. I mean, I called on a guy and had the same conversation. He was like, this is perfect timing. The lender that I was with can't do the permanent financing. The asset was, the value was added, right? We've got extremely good, terms and pricing for this person. And it, I'm thinking there's a lot of that going on now that had that first part of the bridge that, added the value, and whoever their, lead lender is right now is not able for whatever reason to do the mini perm. And so, I mean, I think there's going to be opportunity for us to help some people out that way as well.
Yeah, and from like just taking a different perspective now, just from like a very big picture, just kind of what's your guys' just general perspective next couple of years, commercial debt, I mean, or is it just no one wants to go there and throw the crystal ball out?
I'll address the insurance company side because, I think there's some good points to discuss there from, insurance companies are asset allocation lenders. So, each year, they're going to invest a certain percentage of dollars into mortgages. Figure most insurance companies want to be somewhere, portfolio wide between 6 and maybe 12% invested in mortgages.
Oh, okay.
There are some outliers. There's some really, small balance insurance company lenders that will go to 20 or 25%. We have one that actually, will go up to 40% of their assets invested in mortgages. So there are some outliers, but, year over year allocations from 2021 to 22, we're up about 10%. 22 to 23, we're up about another 10% for the most part. So they are lending into the market. These are some of the best loans they're going to underwrite because the market is disjointed. Yeah. And so not that, for lack of a better word, they have an opportunity to cherry pick. They have an opportunity to pick the best sponsor. They have the opportunity to pick the lowest leverage deal, the best corner location.
Yeah.
These are deals that when the market is hot and the credit unions and the banks are really aggressive, they miss out on a lot of that stuff because, insurance companies aren't last dollar lenders. Mm-mm. They are generally lowest rate lender on a moderate to low leverage approach.
Yeah.
And so this is an environment where they get an opportunity to really do what they do best, which is, cater to the, conservative borrower who is really looking to secure the best interest rate possible, generally, at a moderate leverage. And so they look forward into, 23 and even out to 24. They understand that rates are going to be all over the place. But they are not as subjected to the shifts as some of the other lenders are that are, borrowing from the Fed or that are raising third-party capital, in a securitization model, things of that nature. So they can control it to an extent. They're still subject to where corporate bonds are moving. And generally speaking, insurance companies are going to price over a corporate bond, whether it's BBB, AAA. They'll layer on some spread there and that will, produce their rate, so to speak. But there's a lot less volatility in that sector than there is in the bank, credit union, securitized lender space.
Has there underwriting or DSCR ratios changed at all, in generally speaking, for life insurance, or about the same? Just people are bringing more money now.
That's the cure all.
Yeah, higher down payment, right?
Higher down payment, lower leverage. To answer your question, underwriting is definitely tightened. I think when you think about insurance companies, they have their models that they're going to stress deals to. And, if you go back over a 20-year period, the easiest way for them to do it historically was, hey, it's a 6 cap market in this market that we're lending in. Let's just stress that we're going to underwrite our deals at a 7 cap or a 7.5 cap and lend 75% leverage. Mm-hmm. So in essence, what they're doing is they're saying, hey, you know, we're going to stress the cap rate. We're going to give you a full loan on our underwriting. But what ends up happening is you end up being about 60% of actual market, 75% of their stressed underwriting.
So this is a totally random question, but you brought up stress testing, which is obviously very important. I mean, how many banks and life insurance companies stress tested this type of interest rate rise? Like, is that common in models? Because everyone's been caught a little bit off guard with how fast things have risen. Or has that been for underwriters like, hey, we looked at, we modeled
the
this?
insurance company, definitely rely on us to bring actual market data to the table for them to review. And then they've always looked at that actual in-place data. And, look, there are some market rate underwriters in the insurance world, that will push. But the vast majority of them do have tests in place for a reason, no matter how aggressive the marketplace is. Look, I don't think banks and credit unions, avoid that process. I think they have their mechanics in place, whether that's a global cash flow test that they run, for borrowers, which includes the subject property and them as individuals, what their free cash flow would support if that property went vacant. So there are some tests there.
I will tell you on my side is it doesn't seem like it. Because, we were doing a lot of deals for a lot of years that, underwriting at 3.25 and it would work at 3.25 and there are no questions asked. I spoke with a lender probably 2 weeks ago, and he said we can still do the same thing. We can, I've always been able to do 70-75% leverage, 30-year amortizations, but we have to underwrite to a 10% debt yield and a 20-year amortization. I'm like, that doesn't even, we're not talking about the same things.
No.
So now they're really, honing in on it because they may have missed the boat. I started seeing like the stress test halfway through last year, but for the prior 18 to 24 months,
it was all on actual.
It was all on actual. That's what I saw.
Yeah.
At least for me, maybe there's something in the back office that I was not aware of, but they are now.
That's fascinating. Yeah, as you're talking, Michael, I'm curious about that because that's the model when I've done, again, I am not an underwriter, but I do my what if scenarios.
Right.
Yeah.
And that was not one of my what if scenarios.
We are still seeing, and I'll leave them nameless, we are still seeing term sheets from lenders that when you actually run the underwriting based off of the terms they're offering, the deal does not work.
Really?
Yeah. Hey, we're going to lend you, X leverage subject to a 125 debt service coverage at this interest rate and this amortization. And when you plug that in and look at the cash flows,
right,
it's like at a 1.08 debt cover. So what they're offering you can't get done.
Oh,
and a lot of what we do, look, we I would love every one of our opportunities to be exclusives, but that's unrealistic.
Yeah.
The reality is we sometimes come in after someone's been put through the ringer and we're being asked to help fix the situation. And a lot of those situations could have been avoided if you actually just underwrote the deal properly, where what the lender is offering you actually doesn't work.
But it's hard because, a lot of people, and you'd be amazed, don't know what they don't know.
Oh, yeah.
Right? They call somebody or call a lobby and say, I need a commercial loan, and that's it. Probably work with at least half professionals and half, I'll be honest, like even family offices that, don't have as much as you think that they would because, I have $150 million in real estate, really don't know what they're looking for. And so, they're shared one thing and get excited. And then that's, like you said, that's what it is. And it comes through and they're like, sorry, we can't get it done unless you want to put another, X amount percent in. And it's
where we're seeing that a lot right now, to your earlier question about how much has the run up in rates impacted what's going on. We're seeing it significantly in the construction space, where there are lenders willing to provide construction financing up to 65-75% loan to cost. But what's happening is when you run the exit analysis, someone may be willing to give you that construction loan today.
Right.
But when you go to refinance it in 18 months or 24 months, we don't know where rates are going to be, number one. But let's just take a snapshot in time. Look at the rates today. what sort of debt service coverage can you support if it was ready to go today? You really have to look at that. There are a lot of developers, some experienced, some less experienced, that are just looking on the front end, not looking at the takeout scenario. Oh, well, I'll just sell it, if I can't refinance it. Well,
gotta have a buyer.
Right. Gotta have a buyer, and they've got to finance.
And they gotta have a lender behind them.
So, things are rapidly adjusting.
In flux.
Fluid. I mean, it's stressful as an investor. It's also from just watching the market. It's also very interesting and entertaining a little bit, just watching how things shake out. I love that perspective.
Yeah.
And I really appreciate you guys coming on here and just sharing. You guys have such unique perspectives of where you sit in the, in the crossroads of the commercial real estate world. But as we wrap up here, I know Adam, Michael, you guys with Slatt Capital have some from what we've talked about offline, some pretty aggressive plans to expand here, future plans in the marketplace with, a bigger office, more lenders, getting more market share. Who's the right type of client to reach out to you, and who do you want to network with more now that you're out here in Colorado?
I would say on my side, borrowers that are looking, borrowers that are looking to refinance right now that are kind of in the situation that we talked about where, maybe they have some debt maturing in the next 6 to 9 months and really need to take a look, and get some of that underwriting done and have somebody really be able to tell them the truth on what can actually get done and maybe even forward lock some rates. I would say that's who we're going to focus on. As far as in brokerages here around, I would say specifically probably retail has been really strong. Industrial continues to be a good asset class to get done and people are aggressive on, and then multifamily if it's stabilized. Those are the type of brokerages I think that make a lot of sense for us to talk with regularly. Office deals can get done, but they've got to be pretty cherry. We went to a few conferences in there, that was kind of a 4-letter word on that side. So, self-storage is getting done as well. So, people that are going to have debt maturing on that side. And then I'll let Michael talk about how he, the thoughts on, building out the office
yeah, I think, look, we've talked for, 30, 40 minutes, and there was a little bit of doom and gloom in some of the, the underlying tone. I want to be clear. There is tremendous liquidity in the market right now. It's but again, we've really bounced high off the bottom levels of where rates have been, and there needs to be an adjustment period, and we're going through that. But, compared to the Great Recession and other, kind of pre-recession time periods, go back to .com boom or bust for that matter, there were liquidity events.
Yeah.
Things stopped. There is plenty of liquidity in the system across all lender, product types. So, again, there is an opportunity here. So, I want to, I'm bullish still within this market, but we are going through an adjustment period. So, as it relates to Slatt Capital expansion, as we said earlier, the attractive part of the Denver and greater Colorado market for us is there's a history here with a lot of our existing clients. Yeah. There's a history with local people that are now part of our firm here. So the desire to build a strong regional presence because our lenders are asking us to grow in this market is exciting.
Yeah.
So
it sounds like a lot of stars have aligned.
Yeah, it's taken time.
Well, it always does.
Right.
And it takes longer than you expect, too.
Sure. But, we've had conversations with some of the professionals that are here now with us for, 10, 15 years because, there is a demand for a number of our lenders to grow their portfolios in this market. Yeah. And to Adam's point, product wise, retail for the last 5-6 years has kind of been the 4-letter word. It's really, it's in the top 3. So retail, we look forward to, putting dollars to work in that space. And that's across, strip retail. That's across single tenant, good credit retail, grocery anchored for sure. you know, that again, in the life company space, their favorite products are industrial, multifamily, you know, and they'll do as much of that product as they can. But you know, we're excited. I mean, I think there's a lot of opportunity. It's a great middle market area. It's continuing to grow. It's continuing to attract population to the, you know, dismay of some, you know, Colorado people. But the fact is there's not too many better places to be.
I agree there. And that's why from the long-term, you know, macro point of view, it's a great place to always invest in.
Yeah.
Well, guys, thank you so much. Like, I know you're in town for a few days, Michael. I am very, very thankful that you carved out time to come to the studio.
Yeah,
so thank you.
Great.
Look forward to having you guys on the podcast more, especially when you're in town, Michael. And just in general, if you guys out there, you're an investor, you're a broker, you're in the space, I mean, reach out to me. Most importantly, reach out to Adam or Michael. I think Adam would probably be the best point guy here for Denver stuff. I'll make sure all their contact details in the show notes. But of course, as always, reach out to me, and I love playing Connector. Adam, Michael, thank you.
Thank you.
Thanks.